What is dollar cost averaging and what are the benefits? Let's find out. Hey, this is Matt from Let's Not Be Fools, the channel that brings you financial and other advice a couple times a week. Hey, it's a great summer day. Let's get into dollar cost averaging. What is dollar cost averaging? It's an investment strategy that allows an investor to buy the same dollar amount of an investment at regular intervals. The purchases occur regardless of the asset's price. It's a way to minimize the risk from market fluctuations. The purpose is to lower the average cost of the investment and reduce the risk of buying at the most inopportune time. In other words, it's a way to avoid putting a big lump sum of money into an investment at the time when the investment price is very high. And fourthly, consistency is key, and you'll see that. So let's assume you have your eye on a certain stock and you've decided you're going to invest $100 per month over 12 months into that stock. Let's assume in January that stock is valued at $5 per share and you are going to invest $100. So with that $100, you're going to be able to buy 20 shares at $5 per share. For simplicity reasons, let's just ignore the transaction costs, the trading cost. Then the next month, the share price doesn't move, it's still $5. You invest $100, you buy another 20 shares. In March, let's say the share price jumped up to $10, you get 10 shares for your $100. And so on through the year. Let's just go out through 12 months. And let's just assume the stock went up to $20 a share in April and then dipped down in June and July back to $5 and then went way up in October. And each of these times you purchased $100 worth of those shares every month, and you'll see that I have noted how many shares you actually bought in each month based on the price. And obviously this is a real extreme example. This is not really how most stocks are. Most stocks don't move this dramatically, but I just wanted to show the impact of dollar cost averaging on various price points of a stock. And that's why I made this dramatic example of this stock going up and down dramatically over the year, just for example purposes. So over the year, in summary, you purchased 134 shares. You paid $1,200 for those 134 shares, right? $100 per month over 12 months. Your average purchase price was $8.96 per share. And again, we're totally ignoring transaction costs. You may pay $8 a trade, so let's say 8 trades over 12 months, that's just under $100 in expenses on trades, but we're just ignoring that. The lowest price paid was $5 per share. The highest price paid was $25 per share. And at the end of the year, the value of your stocks was $2,680. And again, that's a dramatic example. That's not really realistic. This example really illustrates the intent of dollar cost averaging. You're not wanting to pay the highest price for the stock. You're not necessarily paying the lowest price for the stock, but you're consistently putting money into that stock every month, buying a certain amount of shares, and on average, your per share price is not the highest, it's not the lowest, and it allows you to buy more shares when the price is down and less shares when the price is higher. So as an investment strategy, is dollar cost averaging really better than lump sum investing? Historically speaking, it's probably over 50% of the time that lump sum investing will come out ahead of dollar cost averaging. If you had $1,200 on January 1st and you can invest that all into the market or into one stock in January, you may be better off at that point doing that than just spreading that $100 over 12 months into that same stock. Dollar cost averaging does have its place though. If you feel like the market is overvalued, then dollar cost averaging may be a good strategy in slowly putting your money into the market so that if there is a big market downturn, at least all of your money is not in the market at that time and you can buy into the market or that share price at a lower point later in the year. But again, I think lump sum investing comes out ahead in the long term, but dollar cost averaging certainly should be a strategy that you should consider. I'd say the last bullet point here is the most important. Consistency is key. If nothing else, dollar cost averaging is beneficial in that you are systematically putting money into the market at regular intervals, and that's a lifelong habit that you should learn and keep doing over time. You'll be rewarded for it. Don't forget to click the subscribe button so you don't miss a thing. I appreciate you watching. Have a great day.